What keeps many owners up at night? Debt and risk. Brought to you by CFO On Demand from Fitzpatrick, Bongiovanni, and Kelly CPAs. Please support our sponsors: McPeak Wealth Management Group of Wells Fargo, Ansero IT, Levin Stoller, Attorneys at Law, Allegra Marketing, Integris Investing, Tim Pashley, Cooper Levinson, Attorneys at Law, Rich Asset Management, Ocean First Bank, Sturdy Savings Bank, Bank of America, Persky Marone, Attorneys at Law, Merrill Lynch, Altor Oakley Group.
Levin Stoller, located in Atlantic City, for over 40 years, Levin Stoller has provided high-quality legal services to our clients. Our business attorneys provide both large and small companies with practical and cost-effective legal advice, including business entity formation and agreements, sales, leasing and financing, and outside general counsel services. Our tax attorneys work with CFOs, accountants, and other finance professionals to develop business and personal tax plans that satisfy each client's individual needs and objectives, including business entity taxation, structured transactions, and tax litigation. Our litigators engage in a wide spectrum of commercial and corporate litigation, including matters involving breach of contract, employment litigation, insurance claims, and partnership, shareholder, and LLC member disputes. Our labor and employment attorneys provide assistance and advice to CEOs, CFOs, human resource professionals, and office managers. Our services include drafting employment and severance agreements, handbooks and employment policies, counseling and anti-harassment training, and defending discrimination and hostile work environment lawsuits. Our estate planning attorneys have extensive experience in estate planning and administration, including wills and trusts, sophisticated tax and estate planning, business succession planning, and estate administration. Levin Stoller's attorneys and support staff ensure that clients receive prompt, thorough, and cost-effective service for all their legal needs. Please visit our website at levinstoller.com for more information.
And now our presenter, Lou Bongiovanni.
Hello and welcome. Sorry about that technical difficulty in the beginning. This is Lou Bongiovanni and welcome to our very live webinar. Today we're going to be talking about debt and risk and what keeps people up at night. The items that we're going to cover in the webinar are how to manage business debt better, determine the right amount of debt for your company, risk tolerances impact to your success, and lastly, the 7 ways to achieve your ideal debt and risk balance. In my experience, the way business owners manage debt and risk is a critical factor as to their success. Many people think it's how well the product or service is delivered, or the timing of the service, and they're all important, don't get me wrong, but how a business owner looks at debt and looks at risk is such an important, critical factor to their success. So let's jump into debt. Okay, let's define the debt that we're talking about. I broke it up into two separate categories. One is transactional debt, and this is the debt that you normally come across on an ongoing basis, and that is credit card debt that you incur as part of your business. Also, accounts payable, which is your normal debts and obligations to your vendors. Those kind of debts are more transactional. They happen on a fluid basis. They're usually not large, unmanageable numbers. If they are, then that's problematic. But this type of debt is one that is in the normal course of business. Less of a concern with managing that. People are pretty comfortable, or business owners are pretty comfortable with that type of debt. The next type of debt in a broad category is financing. This is the debt relating to whether you see some tractors there, whether it relates to buying equipment. It could be in the form of lines of credit, which either renew annually or every few years, where you'll have a certain amount of funds available for you, whether or not you use it, and then you pay interest on it accordingly. Or if there's a term loan, you're giving a certain amount that you've borrowed, and you have to pay back either a short-term period, let's say 5 years or less, or a longer-term period beyond 5 years. And that's all a matter of what the nature of the asset is. So you're not going to pay off a building in, let's say, 5 years or less, but you might pay off a piece of equipment. And by the same token, you're not going to buy a piece of equipment that's going to last you 5 years or so and paid off over 20 years. So those type of loans, or that type of debt, is the type of debt that a normal growing business will incur. However, if not managed properly, that debt could strangle or even cripple a business. Next, I'll talk about a couple of things that create some bad debt situations for companies, and then we'll talk about what good debt looks like. Okay, so the first bad debt trap I want to talk about is you pay too much for the business. Many times, if people are buying a business or buying a franchise, they're very anxious, they're very excited about purchasing it, and they move forward and negotiate as best they can the price, but sometimes their emotions get the most of them, and they may overpay for the business. Some business owners think, okay, if I overpay $20,000, it's a larger, it's a big transaction, what's the big deal? Or something such as overpaying by, let's say, $20,000 using a 6% interest rate over a 10-year period will cost you about $27,000. Now, that extra $7,000 might not sound much when you're starting out off, but when you're in business in those first few years, that $7,000 could mean the difference between buying an income-producing asset or marketing. So it is a critical dollar amount. So you need to be careful from the get-go as far as how much you pay for the business. Another debt trap is undercapitalized business startups or a new venture. I see this all the time, and over the 30-plus years I've been doing this, unfortunately, I've seen this more so than probably any other debt trap. Business owners are excited about diving into either a new business or a new venture within their existing business. They focus on the revenue generated and the profitability, but they don't give enough mindset as to what capital is needed to fuel this revenue stream. And many times, because of that, they are thinly capitalized and need to leverage debt or get too debt burdened in their business, and sometimes that could jeopardize the business venture or the new business startup. Invest too much in unproductive equipment. You might want to invest in equipment that's income generating. My thought comes to a dentist that I worked with years ago who wanted to invest in a piece of equipment, thought he'd get new procedures out of it. We determined how many procedures he needed in order to break even, and then obviously anything above that would be profitable. And when we allowed for a certain amount of time and we weren't hitting our numbers, we knew to pull out of that arrangement. We had some fallbacks to allow us to get out of that long-term lease. But some people might not think of those terms, and as a result, now they're paying for an asset or a piece of equipment that's not generating the cash flow for them. That creates bad debt. Financing an extended down period. If you've been in business for a few years, you'll remember the recession of 2008 spilling into 2009 and the subsequent years from that. Many businesses that were marginally profitable going into that period of time were devastated with the recession. Some of them didn't survive. The ones that did, some of them were limping along. It really strapped their business. So one thing that you need to keep in mind is that debt can grow based on you trying to survive a downturn. There needs to be a plan in place as far as how to rebound from something like that, and we'll talk about that in the next couple of slides. But that too can create some business debt traps. Member or shareholder buyouts. This is a fact of life that members and shareholders move in and out of businesses. When a shareholder or member wants to be bought out and the remaining members or shareholders want to buy them out, it's important that the right dollar amount is determined. I've been involved in transactions where, again, it gets emotional. It's somewhat an emotional breakup, it can be. And sometimes a business owner will overpay just to get the departing owner out. It becomes more of an aggravation factor. Be careful as far as the premium you pay for that, because again, the business owner that remains is strapped with that cost, and that'll create some debt burdens that might be hard to overcome. And lastly, and unfortunately I see this and have seen this quite a bit, is businesses can't support the owner's compensation. A business owner goes into a business venture having personal needs for a certain amount of income. They need to make a certain amount out of the business venture in order to live the lifestyle they desire. If the business is not able to support what that income need is, and it's important that as early on in the process, the business owner is honest and accurate with what they need, the business can be strangled from being able to run as it normally should, or even to grow. And when I see that, I think this business is dying a slow death, as the business owner doesn't really give it any oxygen, if you want to use that metaphor, to reach its potential. So I've seen business debt grow for that reason. These reasons that I mentioned are all bad reasons to incur debt, and reasons that create anxiety for business owners because they're dealing with either a poor decision or a string of poor decisions that either were created internally or possibly sometimes externally. Now let's talk about good reasons why you should incur debt. So business debt, some good reasons that I've seen over the years. One is to acquiring income-producing assets, such as equipment or real estate. So the example I gave with the dentist and the piece of equipment. So if you have an owner, or the thought comes to a plastic surgeon who had a piece of laser equipment that they found that they can do other procedures. When they moved forward and they marketed that, he found that his estimates were accurate, and he was able to generate the income he needed to not only afford the cost of the equipment, but to profit from it. So acquiring income-producing assets, great reason for for debt. Another great reason is acquiring a new line of business. So if you are in retail and you want to expand your retail line, for example, within your own location, you need to acquire maybe some shelving, some displays, as well as the actual inventory. They're all excellent reasons to incur debt. Third, acquiring a new location altogether. You see a demand in a particular area that you can benefit from, so you want to open up a new location there, whether it's a retail store. I work with a liquor store. That's something where it's very sensitive to where it's located. And another good reason to incur debt. Expanding an existing location. Again, if you have the opportunity, working with another retail establishment that comes to mind, they had the opportunity to expand their existing stamp. They loved the location, but they were outgrowing it. That is a good reason I've seen entrepreneurs incur debt. And last, to enhance your product or service. If you feel that your product or service needs to be updated or enhanced to keep up with competition, they're all favorable reasons to incur debt. So many times I come across business owners who indicate that they want as little debt as possible, or they don't want debt at all. When I hear that, I think that the business owner is really limiting how much they're going to have the business grow, because a complete aversion to debt is not healthy. It's not entrepreneurial. It's really not the mindset that a business owner who wants to take advantage of opportunities should have. Now, by the same token, you don't want too much debt where it chokes you. So there has to be a right level or a sweet spot as far as how much debt your business can handle. And that leads me to the next section, all right, which is the question, what is the right amount of debt for my company here? Well, what I found is there's two ways of measuring that. One is a quantifiable way, such as using ratios and indicators. And the other one is a qualifiable way, as far as what your tolerance is for debt. I'm going to discuss both of them next. First, the quantifiable way. I'm an accountant by background, so I like measurable things if I can have them. So let's talk about what type of debt determining ratios there are. One of the most popular one is a debt to equity ratio. This you've heard this term, whether you're talking about stocks on the New York Stock Exchange, or you're talking about Joe's grocery store on the corner. A debt to equity ratio is a liquidity ratio, and it compares the company's total debt to their total equity. How much is the company borrowed versus how much has the owner put in? They look at that as a ratio, and that becomes your debt equity ratio. Just as a follow-up to that, the higher that ratio is, it indicates that there's more borrowing or creditor finance compared to investor financing. So the higher the ratio, the more you've borrowed as compared to put into the company. I give you some industry averages here so you have a sense for it. So the S&P 500, which all of you know what that is, the debt to equity ratio on average is 1.5 to 1. So companies in the S&P are borrowing $1.5 to every $1 they invest in the business, or they have invested in the business over time. Transportation companies, it's 1.14 borrowings versus what they put in. You see service companies, retail, and utility companies. It gives you a range there, but overall they cluster at about 1 to 1.5 times. So usually companies are borrowing dollar for dollar what they have into the business, or maybe $1.5 for every dollar that they have into the business. That's a general benchmark. You can get more specific to your industry for sure, but I wanted to give you some general ideas as far as some common industries and what debt to equity ratios look like. Another very common measure as far as what amount of debt your business can support is the debt service coverage ratio, or I've also heard it called debt coverage ratio, but it's really technically debt service coverage ratio. It measures the cash flow available to pay the current debt obligations. These are very popular with bank financing. You cannot really request a loan without the bank looking at this particular ratio and giving you some parameters in which you need to stand within as the lender. You take the EBITDA, which is earnings before interest, taxes, depreciation, amortization. You divide it by the interest and current principal payments on the debt. You also include leases there, and that becomes your debt service coverage ratio. So it's EBITDA over the principal and interest of your current year's debt. And just to follow up with that, the higher that ratio, the more comfortable a lender is that the company can handle their current debt and maybe can incur more debt. So the higher that number, the better. Lenders usually require a 1.2 to 1 ratio. So your EBITDA needs to be 1.2 to every dollar of principal and interest that you need to pay. Some companies are clearly way above that, which banks just salivate wanting to lend them money. But some, if they're teetering around that, the banks want to make sure it doesn't fall below that. If it does, it is a problem with the debt covenants relating to the company. So this is critical to all debt covenants that I've seen. Interest coverage ratio is the last ratio I'll talk about to answer that quantifiable question: is how much debt should my company have? That is the earnings before interest and taxes over the interest expense. It's used to determine how easily a business can pay just the interest portion of their outstanding debt. So if a lender says, I want to know that you at least pay me the interest, not overly concerned about the principal, at this point, this at least gives you an indication that can they at least do that. And there should be around a 3.02 or higher ratio when it comes to EBIT over the interest expense. That's usually a sweet spot. If it falls below 1, then bells and whistles go off with the lender. That's you're in the danger zone. So there are definitely quantifiable ways. I gave you 3 of the most popular ones to answer that question, and I get it often. People seem to think there's some kind of magical formula. Not really. There's 3 key ones. Now, the other qualifiable aspect of it is the your comfort level. This is not based on any computation. This is more a feel for the business owner here. Some business owners, I find, look at what their average cash balance is, and they base how much they feel comfortable borrowing on that. It's not scientific, but many of them look at that, so I throw that out there. And then it's really the owner's individual tolerance for debt. Some business owners, as I mentioned to you a minute ago, are okay with that and feel that it's necessary and it's part of the overall risk of the company. Others just want as little debt as possible. They think that, what about if my company goes out of business tomorrow? How much am I going to be personally obligated to? So it really depends on it. And owners, I put owners as plural because not all of the owners are on the same page. We'll touch on that in a minute, and that could be a concern as far as how owners feel about that. And lastly, a factor as far as someone's debt tolerance is what their business outlook is. If they feel that if they're in the transportation business and, for example, and they feel the outlook might be a little bleak because autonomous vehicles are going to take over what they're doing, they might be less tolerant for risk because they might think that their industry or their company is on the tail end of it, and they don't want to be left with a lot of risk and not the ability maybe to sell at a high price to pay it off. So an owner's business outlook is a factor as well. As far as types of risk, we have, I broke it down. There's many different types of risks. The 3 I want to focus on are industry risk, company risk, and then investment risk. We'll touch on each of these right now. John, fine. Good. Okay. So as far as industry risk, I view industry risk as an external factor. Not much you can control as far as the industry overall. I list some indicators here or some things, factors that impact industry risk. External taxes, we've gotten favorable legislation with that. Tariffs have been in the news lately, so I throw it out there. That may or may not help your particular industry. There might be a supply shortage. If you're in the food business and these hurricanes, that might impact your supply. And then overall, the one that permeates every single business that I'm aware of is advances in technology. Whether you're going to stay on the cutting edge of technology and make the investments in order to do so, or whether or not you do not want to stay on the cutting edge and take a different route. So these are industry risks that come into play as far as a business owner has to consider, but really can't control. Company risks are more internal. I view them as things that business owners can control, and many of those risks are coming from the operations of the business. So you're dealing, when I think of operations, I'm thinking of the 3 Ps, if you will. One is the people. The risks of, let's say you have a key employee. If you're a restaurant, you have a key chef, and that person decides he wants to retire, or he wants to leave, or he wants a big raise that you don't think you can support. There's risks there. Process, is your process working the best as it can, or are there flaws with the process that need to be improved upon because maybe it's archaic? And last, the actual product or service that you're delivering, is that still something that the public demands, and are you delivering the best product or service that you can? So these are company internal risks that need to be managed. So when we talk about a business owner and their potential for success, how they manage debt is one, but how they manage risk is a close cousin as well, because they need to, in their minds, sort out their comfort level with the external risks of the industry and the internal risks of their company. Investment risk is somewhat of a different animal of risk, at least in my mind, because that's the amount that you're willing to invest or put at risk from your personal assets. You're looking to start a business or expand, and you can only borrow so much. And we talked about a 1 or 1.5 to 1 ratio, but you're going to have to put some money in there as well and risk the personal assets you've accumulated. Business owners need to be risk takers if they're going to be successful. Some are overly conservative, and that inhibits their growth. But some of them can be reckless, and I've seen that too, where they're just they're all in. It's kind of a glorified gambling, and that has its rewards and its perils as well. One size doesn't fit all for a business owner. So you could have identical businesses, but depending on how the business owner views debt and risks, especially investment risks, can have dramatically different outcomes. The role of insurance can mitigate some of these risks, but it's not a panacea by any means. So when we talk about an insurance advisor, things that I think need to be discussed with your insurance advisor to help you manage your risks are these. One is determining the value of your business, what the current value is and what you think it'll be in the near future if you think it's increasing or frankly decreasing in value rather rapidly. Insurance advisors are there to help ensure what assets or income stream that you have. And if they don't have a good read as far as what that is worth, the amount of insurance you're going to buy might be much more or much less than you need. And you don't want to be in that situation. So you want to be true with what this business is worth right now. And that could change. So you should review that annually, biannually at a minimum. How much insurance can you afford, especially with smaller companies? I'm not a big insurance person. Maybe I'm out of the norm because I think financial people tend to overpay or overinsure. I'm not such that way, and I think entrepreneurs tend to underinsure, so there's probably a good sweet spot there. But depending on how much you want to insure will factor in how much you're looking to pay. If you have an amusement and you want to try to insure for any possible thing that could happen, you're going to pay a steep premium for that. But the reality is, over the years, you have to weigh the likelihood of those things happening versus not, and that will end up impacting you financially as far as the premiums that you're looking to pay. An owner's risk tolerance too comes into play. There's usually questionnaires or surveys that an insurance person will ask in order to get your tolerance for risk. Not unlike when you're looking to invest, and an investment advisor might ask you questions as far as how risky you want your investments to be. This is of a similar vein here to get a feel for what allows you to sleep at night. And other outside requirements, there might be some requirements to be insured up to a certain level if you're in a certain location, or if you have a certain contract with a customer that requires certain minimal insurances. The construction business comes to mind, where there's a lot of outside requirements that you have to hit a minimum amount at least. So those things should all be reviewed with your insurance advisor. And if you have a person who is accustomed to doing these things on a regular basis, they can be extremely helpful. Okay, next I want to go over the 7 ways to achieve your ideal debt and risk balance. We've talked about debt and good debt and bad debt. We've talked about risk and what types of risks there are and how to manage it and how to mitigate against some of it with the insurance. Now, as I do with all my webinars, I'd like to give you some takeaways. So here's the 7 takeaways that I found have been helpful over the years dealing with risk, managing risk, and debt, which are so critical in the success of a business. Number 1 is match the debt to the income stream. Does a reason for the debt generate either new revenue or save costs? It's important that when you incur debt, you're usually buying an asset or that produces income or an income stream of sorts. And you want to make sure that the debt that you're incurring as it relates to that particular asset or income stream is enough to pay for it. If you just are buying a piece of equipment just to buy a piece of equipment there, and you're not really looking at the return on that particular investment, you might fall into a trap where that particular debt is not warranted for that asset. And if you do that enough times, that number starts growing. Can you do it once or a couple times of small nature? Sure, most businesses can handle that, but frankly, it's not a good pattern to get into. It's not a good discipline to get into. If you want to be financially disciplined as far as managing your debt, I'm not saying avoiding it, but managing it, this is a must. Number 2, debt refinance options. If you are in a debt situation and the lending environment has changed or has allowed you to revisit your debt structure, by all means, I suggest doing that. So when interest rates are dropping, you want to revisit your debt structure. If they're going up, you may want not to. You might want to stay put where you're at. But that's an assessment that you need to make as you see interest rates in particular come into play. So either lower payments if you want to extend the time. Let's say that the ramping up of a particular venture is taking longer than you thought. So rather than paying off in 3 years a particular debt, you rather extend it 5 years. That'll give you enough ramp time. That's what you would do there. Lower interest rates, as I alluded to. If rates are down or you can get more favorable rates, you want to shop that as best you can. And then debt consolidation, if you have, the one that comes to mind is if you have, let's say, multiple vehicles or multiple vehicles are usually a good example of it, where you can consolidate all those vehicle loans and maybe have a line of credit or a short-term loan at a more favorable interest rate, $1 amount as opposed to multiple ones, and pay off the debt sooner with lower interest rates. That's an excellent way of managing your fleet debt. Number 3, negotiate a debt payoff. This you want to use sparingly as needed. Our president is masterful at doing this. He's done this many times, frankly, even locally, as far as if he finds that his businesses are not performing, underperforming, and he wants to minimize his debts, he'll look to pay a certain discounted rate just to get out of the obligation, or he'll threaten to go bankrupt, or whatever the case may be. And again, you don't want to use this strategy on a regular basis. It's somewhat of a scorched earth strategy, because after you do this, it's very hard to continue relationships with certain vendors. Although if you do it with one vendor and then you have other vendors to use, it might work. This is not for the faint of heart. This is hard-nosed negotiating that you need to do. But frankly, if your business and your livelihood is at stake, you take this route and you do that. But it could impact long-term relationships, as I mentioned there. Number 4, determine the right debt amount. Now, this really speaks more to the quantifiable and the qualifiable things that we talked about. Our debt ratios in line with industry averages. If you have any borrowings with the bank as part of their annual renewal process, they perform all these ratios for internal purposes. My big gripe with banks when they've done that is, why don't you share it with the borrower here and see where they're at? Now, as CFO on demand clients, we do that on an annual basis as a minimum with our clients, so they see that, but not everyone's a CFO on demand client, unfortunately. And people need this. Business owners need to know where this debt ratio is going over a trending period of time, whether it's looked at on a quarterly basis or on an annual basis, and see if that debt ratio works, because that's a moving target. So just because it worked last year or 2 years ago doesn't mean it automatically stays within the average. It can move for various reasons, so you want to keep track of it. And then again, can you sleep at night with whatever that dollar amount needs to be? Now, that answer might change if you're 45 versus if you're 65. So your risk, your tolerance for debt might change as you get older and as you're looking more towards retirement. So you have to factor in those items there. And when you have different people with different tolerances, that tends to be a difficult conversation that needs to be had, and you need to find some kind of a common ground with that. We'll talk about that on another slide, actually. All right, number 5, assess your risk tolerance. Now we're shifting from debt to risk, and again, the two are almost interchangeable, but now I'm speaking more so to risk. Worry more about the debt assumed or the lost opportunity. You need to really take a feel, get a feel, again, with your help of your insurance professional, I would suggest, as far as what's your tolerance for risk in your company, taking into consideration where your company has come from and where it is now and where you anticipate it to be, and where you think the industry is, the local demand. That's an exercise that should be done, I think, annually as part of the annual review process of your company. Okay, number 6 is consult your risk insurance professional. We talked about surveys or questionnaires. Your insurance person will most likely have a lot of experiences, preferably with people in your industry. So they can give you a good read as far as maybe what other people are doing, so businesses maybe bigger than yours, or businesses that are smaller than yours, and how they can and what they've done, and maybe give you some options. It's really a matter of asking the right question, I found, of your insurance advisor. They have a lot of knowledge. A lot of times they just they might assume that you know, you've already thought it through. But I think it's a worthwhile exercise. Go out to lunch with them, or a separate just meeting. Get a feel for those things, and it's not something where you ask 1 or 2 questions and boom, you have the answer. It's more of a feel and a fluid discussion that helps business owners get there. I didn't put it here, but I probably should have included here. It's not only your insurance professional, but also your bank, your lender. That covers the debt portion of it. Same kind of conversation as far as how much debt they're finding businesses of your size are able to handle, despite the ratios and things of that nature. Getting those kind of insights are helpful, especially when you're dealing with a professional who that's all they do all day long. They see a lot of businesses. Maybe they see a lot of businesses in your industry. They can give you a pretty good feel. Obviously, they can't tell you specific clients, but they give you a good feel if you're on the lower end or the higher end of the debt, and what that looks like. That kind of advice is really critical, and it's so easy to obtain, in my opinion. You can get that rather easily, rather quickly. And last is get all owners on board with the debt risk here. These are two guys fencing. Find common ground, and this is easier said than done. And it's one thing if you have owners who are unrelated, um, and maybe they're at different ages or different stages of their lives, and their risk tolerance is different. Finding common ground could be hard sometimes when someone is very low on their risk tolerance and some are very high. One way of resolving that is the owner who is more risk tolerant will secure for more of the loan. They'll sign on and guarantee more of the loan percentage than the one who is less risk tolerant, and that obviously would be up to the bank to decide on that. The other thing too, what I found is not to be stereotypical, but what I found with spouses, if they're the business owners, a husband and wife, husband tends to be more of a risk taker. Wife tends to not be as much of a risk taker. They're more protective of their assets and such. That could create some real anxious conversations, and that's something that you have to agree upon. All right. And the recap of the 7 items: match the debt to income stream, and make sure that you're incurring debt for a return on your loan. Debt refinance options, always be open to those as far as getting the cheapest debt possible. Negotiate debt payoff if it gets to that point with the debt. Determine the right debt amount. We talked about the quantifiable and the qualifiable ways. Assess your risk tolerance, how much risk that you're looking to take in, you being all the business owners. Consult your insurance, and I'm going to add banking professional there to get their insights. That could be very, very valuable. And get all owners on board with the debt and risk. And again, whether the owners are related or unrelated, that can be a challenge. At CFO On Demand, we help our clients manage the risk and the debt. We find it such a critical decision, as I had mentioned to you before, and for those of you who've seen our webinars, our experience is that if you look on the left there, the befores is what we find that growing business owners struggle with, that financial analysis that needs to be done in order for them to make business decisions. And within that financial analysis is how much debt to incur, how much risk relating to that debt they're willing to take. That all falls into that basket as well. What we do at CFO On Demand is that we try to quantifiably measure that and give the business owner options so that, again, they know how much risk they're incurring, and they can decide how much they want to take on in their business. We believe that business strategists make the best business owners. We support business owners and help make them business strategists as opposed to normal operators. We have an example here with Netflix, much more strategic as far as what they saw the market going through, as opposed to, let's say, Blockbuster, who is more looking in the past. You talk about risk takers versus non-risk takers. That's a great example of it, at least I believe. That is our presentation. These are the upcoming webinars. We're going to populate more. We're going to spill into 2019 as well. I just haven't published the ones for next year. I'm going to list them out. But the upcoming ones on October 10th, we have profit leaks. Get this question quite a bit as far as how can I make my business more profitable. Then we talk about budgets. That's the time of the year in which we're handling budgets, so we thought it'd be timely then. And last, we'll talk about fraud and protecting your assets. So they're the 3 coming up. We do have one question that we got, and I was negligent in reminding you that you could submit questions, so I apologize for that. Question actually relates to something that we spoke about here, which is person I'm going to paraphrase the person mentioning here that it's a husband and wife relationship. The wife, again, as I mentioned to you, less risk taker than the husband. How have you found that being resolved? The one thing I recommend with that is quantify how much debt you want to incur or how much risk you want to incur. So at least the wife in this situation can say, okay, I will allow or I'll tolerate up to this dollar amount. Anything above I won't. It's almost like a gambler who goes into the casino and says, listen, I'm only going to gamble this amount, and if I lose it all, I walk out. I'm not going to gamble more no matter what. It's that kind of mentality that I have found at least puts everyone on the same field there, and they feel that they know and they could quantify what their exposure is. Well, thank you very much for joining this webinar. I hope you found it helpful, and we will see you next month. Take care.